We need to move on, though, today, and on Friday, we like to wrap the week. That is our segment where we take a look at how this day's action fits into the week and how this week's action fits into the long-term trend. What have we done to the long-term trend following perspective? Has this made any material changes in the overall approach, overall outlook? Let's try to answer those questions. And usually what I like to do for this is go to the Mindful Investor Live chart list. This is a chart list that I maintain, and if you're not familiar with this, if you've not seen this before, if you go to StockCharts, go to the Articles tab, go up here to all the StockCharts blogs, go to mine, which is called The Mindful Investor, and you'll see Live Chart List, a link right at the top there. Click on that, and you can save it right to your own login. So it's an easy way to get this chart pack directly into your own StockCharts account. Let's start at the top here. So every morning I start with a chart that looks kind of like this. It's a long-term weekly chart on the S&P 500. This is a constant reminder that this week, which finished strong, right? We finished up, we've got new intra-week highs, new closing highs for the index. That's all very positive, but I like to look at it within the context of this long-term trend. And overall on this time frame, it has been essentially an unabated uptrend for this year, at least for sure, really coming off of the December 2018 low. It's been a pretty consistent pattern of higher highs and higher lows. We've remained overall above these upward sloping moving averages. These are long-term. These are the 21 and 34-week exponential moving averages, and that's just a simple trend following mechanism to remind me that overall the bias is positive. This is the PPO, basically based on those two moving averages. So if this is above zero, they're in bullish mode. If it's below zero, they're in bearish mode. They've turned positive in mid-February of last year, and for the last 12 months have been consistently positive. A little more tactical, and sort of the first thing that would trigger on a long-term chart like this is the weekly PPO, or the weekly MACD. This is based on the traditional measurements, 12 and 26 weeks, or 12 and 26 bars, and until that breaks down, until you get a sell signal there, it tells you that the trend overall is very positive. So you can see during these periods, sort of the May, June area, also the August pullback, you can see that the weekly PPO turned negative for a bit, but then all resolved higher. So that's sort of the first warning, tells you things might be a little corrective. You see the follow through with the long-term trend following tool, and that would tell you things are really getting bad. So overall, long and strong, it's telling you to remain pretty constructive on stocks. Breadth we've looked at here, and this is the daily chart for the last year of the S&P, and then cumulative advanced decline lines for the S&P 500, which made another weekly high this week. If we look down at the New York Stock Exchange at the mid-cap index, I've color-coded them sort of this yellow neutral color because they pulled back a little bit. They'd gone to a new swing low, but now back within this range. So if they would break above their previous high from the second or third week in January, I'd flip them back to positive, but overall still sort of a neutral territory. And I've actually turned the small cap version back to neutral as well, because it's come back very nicely. So, the end of last month, end of January, these all felt like they were getting kind of negative, but now all of a sudden you see them start to turn back up. So overall, feeling a little more constructive, or maybe less destructive than they did a couple weeks ago. So that's worth noting. In terms of new highs, this is not updated for today, so this is just going to go through Thursday of this week, but you can see that there have been a consistent number of new highs. So just like the S&P's making new highs, there are plenty of stocks also making new highs. So yesterday, for example, S&P with the new intraday high, 70 out of the 500 S&P names, also a new 52-week high on a closing basis. So overall, plenty of support really, and very few stocks by either measure making new lows. So it tells you that overall it's been pretty consistent here. We talked about the Aaii rankings yesterday. This is the survey data for individual investors, if you're bullish, bearish, or neutral on stocks for the next 6 months. And I thought it was really interesting this week to note the big jump. Last week, they were pretty much flat, dead even between bulls and bears, around 30, 32%. Now that has completely switched. And this week, based on the strength that we saw through Thursday, this comes out Thursday, this came out yesterday, you now have 41% of respondents that are bullish, up from about 32%. So that's tilted it. There are 15% more bulls than bears, which is a pretty big jump from being dead even last week to definitely favoring the bullish side. So a lot of people sort of buying into the rally that we saw this week. I wanted to point this out. This is looking at the ratio of consumer discretionary versus consumer staples. And again, the ratio here at the top has broken to a new swing high, but that's driven from a small number of mega cap names. So Amazon is a huge weighting on this ratio. If you look at the equal weighted version, so equal weighting all the stocks in both sectors, it's still actually in a weaker position. So I think this speaks more to the strength of some of the mega cap consumer discretionary names as opposed to a broad-based move to consumer discretionary, still favoring consumer staples over time. So an interesting stock picking theme there. Semiconductors are a great leading indicator we like to use, thinking of long-term movements. When this group does well, the market tends to do pretty well. It did not make a new high this week, sort of a couple weeks ago. We've not eclipsed that high, but overall back up to that strong point. So certainly suggesting that group is just fine. This is looking at the momentum trade. So momentum, the factor ETF relative to the S&P 500, that actually has been in a pretty constructive mode for the year, right? Sort of bottomed out at the end of last year and has been in a pretty good rally mode. So that, generally speaking, is trend following on large cap names, and that's sort of working here. One other thing I wanted to point out here before we get on to some other charts, this is the relative strength of small caps versus large caps, and you can see how this has continued to go down and to the right. I tell people this is what we technical analysts call a downtrend, right? Lower lows, lower highs. I feel like there are very few of those around because so many stocks have looked relatively constructive, but this is showing you how investors have been favoring the large mega cap space versus small cap stocks. So it's really not telling you to rotate into small caps anytime soon. The flip of this chart would be U.S. stocks versus non-U.S. and same thing. It's suggesting basically mega cap U.S. has been the trade. That's the place to remain. So the concerns would be any breadth weakness will appear before the broad indexes would potentially start to turn. I wanted to finish off our weekly wrap segment today talking about sectors. We had yesterday, I want to say, a sector spotlight, sector setups segment where we're talking about sector rotation and some of the different themes in there, but I wanted to point out just year-to-date returns on some of these sectors. Today we have utilities and real estate that the number one and number two on today's trading. This is looking at essentially year-to-date and seeing where the returns have been. So it's 31 trading days we're looking at. Right now I'm looking at the S&P 500 up 4.7% on a total return basis year to date. I can see some of the sectors have been better than that. Technology, number one, up almost 11%. Number two, though, is utilities, and number three is real estate. So even though tech has been the leader, number two and number three have been utes and real estate, which are really defensive part of the markets, but with a big yield component. After that, we have communication services, and then we have consumer discretionary. The only two out of the 11 sectors that are down are materials, down 1.5%. Materials is a pretty small weighting in the S&P, maybe 2 or 3% at the most. And then energy is really the big loser, down 8.6%. So if we standardize this using the perf chart for the S&P 500, and I've now put that at 0 and looking at all the relative returns to the benchmark, you can see which sectors are up. So the leadership, the positive returns, the outperformance has come essentially from three sectors, from tech, utilities, and real estate. The real drags on performance have been materials, financials, energy. So these perf charts are actually really interesting to dig into, especially as the year goes on. You can start to look at year-to-date returns and see, and because so much of the market pivoted, so many themes changed at the beginning of January, it's a really good time to look at year-to-date performance charts. That is our wrap for this week. We're going to take a quick commercial break, back answering your questions from the Final Bar mailbag. We'll see you in a minute.